Sally Krawcheck, the former president of Global Wealth at Bank of America, says people just haven't saved enough for retirement, and they are going to outlive their money. Welcome back. We are Jeremiah and Jonah, the banking bros through the Money Multiplier, and we are going to have an episode here about passive income time.
Passive income time. All right. Why do we say passive income time? Because that don't make no sense to the average person. What do they think we're talking about?
Now, the average person is going to think of this time as retirement.
Oh,
the time where they no longer want to work to provide income for themselves. And a lot of people we've talked about before in previous episodes are working toward having a big lump sum where they can use the lump sum that they've accumulated over their times working to pay for the remainder of the year.
Or they hope they've accumulated, right? The nest egg approach, right?
Correct.
We don't love that. Why is that, Joe?
We think that if you work on passive income, where your income is going to continue to come in even after you've stopped working, and you have a passive income dollar amount that's higher than your expenses, higher than it costs to live, that will provide a lot more security, comfort, and provide a lot longer for your passive income time, your retirement time,
cash flow,
than your nest egg. So we talk about cash flow. So I quoted something to start this episode. I quoted Sally Krawcheck, who's a former vice president at Bank of America for wealth management and things like that. And she has a strong quote that says people haven't saved enough for retirement. They're going to outlive their money. And while I agree with her, the one thing I'd change is that word saved. Well, again, let's talk about cash flow. Let's talk about the way that Nelson Nash, the author of Becoming Your Own Banker, talks about passive income time during retirement. So I thought it would be very fun to walk through something that I actually had the pleasure of speaking about in person, live in front of about 200 people at the Money Multiplier Mastermind just a few weeks ago. And I was able to lead this discussion on passive income time. So for our viewers or our watchers or listeners today, let's walk through a few things that he says together. So if you'd like, Jeremiah, I'm going to ask you to read a few things for us. So if you go to page 82 of the book.
I know it's on 82. Yeah.
Becoming Your Own Banker.
Yep.
Page 82.
Fifth edition.
Yep. We're actually starting with the first full paragraph. So it starts with, he wants to adopt the infinite banking concept. Do you see that over here? He wants to adopt the infinite banking concept.
Oh, yes.
And let's read that paragraph in full.
Okay, here we go. Let's start there. He wants to adopt the infinite banking concept to provide passive income at his age 70 for the balance of his life. Please notice that I did not say retirement income. I'm dropping that word from my vocabulary. This is Nelson talking, obviously. Passive income is money that comes in every year and you don't have to do anything to receive it. In fact, you can't do anything about it. It just appears.
Now, I don't know about you, but that sounds appealing to me, right?
I'm ready for that at any age.
At any age. I agree with you. Yes. I agree with you. Now, I asked the room, raise your hand with me if you're interested in that. I can tell you now, every hand went up. So I'm asking you at home that you're listening or watching, depending on if you're following on YouTube or just listening in the car to the podcast. Again, it's passive income. It's money that's going to show up in the mailbox. You can't stop it even if you want to, according to Nelson. That's what we're going for here. And we want to show you how that's possible utilizing your banking policy. So next paragraph, if you would, please.
Okay. Mother agrees that this is a worthy goal. She's about the same age as her husband, and they have a 23-year-old daughter, Jill, who is in excellent health.
Keep going.
To accomplish their goal, they decide to put $20,000 per year into a policy on Jill. That's the daughter.
Yep, that's the daughter.
$10,000 will go into the base policy, life paid up at age 64. That just means that they won't put any more after she turned 64, and $10,000 into a paid up additions rider. So Jonah, what I see here is 10 of that 20 base, 10 of it into PUA.
That's right. We're going to have an episode a little bit later where we talk about the splits on some of these policies, because those are very popular for a lot of people on the internet right now, YouTube and social media. They also want to manipulate these splits, but having a strong foundation is very important. What you need to know, if that kind of went over your head, is this policy is built on a very strong foundation. It's not a let me get a bunch of money out of this policy tomorrow type idea.
It's not for investing tomorrow.
It's not thinking about. Yeah. It's this policy is designed and built to think about 5, 10, 15, 20, 50 years down the road. That's what's important. All right, one more. Keep going.
They do this for 20 years, and the father is now 70. At this point, they decide to cease premium payments and to start drawing passive income in the amount of $28,500 per year. This is done by surrendering cash value of paid-up additions. This income is tax-free until the amount withdrawn equals the cost basis of the policy, a.k.a. the premium totals they've put in.
That's right. So this is really important. The reason I brought this up is because a lot of people don't understand that this is possible inside their policy. Again, I was in the room of 200 plus people that have banking policies, that want to use banking policies for cash flow, for cash value, to invest, to buy things now, to do so many things with. And I'm speaking to them about passive income time. And I can tell you that less than 10 people knew this was possible. And that's why I wanted to bring it to you right here in this episode. So if you're looking at our screen right now, you can see some values on it. And if you're not, I'll explain them to you so you understand. What happens is the $20,000 a year premium that the father was paying into the policy, he did so for 20 years. 20,000 times 20 years is $400,000.
Yes.
That makes sense to you?
Got it.
Okay, cool. At age 70, he decided to withdraw the money. It's now passive income time. That's what the book says, right?
Yeah.
All right, cool.
Yep.
So he can do so up to the cost basis of the policy. What that is actually saying is at that juncture, he has the ability to now withdraw the money out of this policy equal to what he put in. Now, here's where I'll stop. You've probably seen us on the internet talking about our 3-cup setup, our 3-cup system. We talk about how there's 3 different pools of money available to you in these policies. The first is your premium payment, what you put in. The second is your cash value, what the insurance company has for you to use, equity value of your policy. The third is the death benefit, the money that you get the money that your family gets after your policies, after you've passed.
Got
your
it.
Policies now gone.
Premium is red cup. Cash value is green cup, death benefits blue cup.
That's right. So what we generally teach you is you want to put your money in the policy where it can earn, where it can grow, where they'll pay you off of it, and use the cash value while you're alive and kicking. Mm-hmm. But during passive income time, you now have the ability to go back to the premium deposit cup or pool of money and withdraw everything that you've put into the policy over however many years it's been. So in this particular case, the father was able to retire passive income time and have passive income of $28,500 every single year for the remainder of his life. But the cool part about this example is that the policy did not stop. Because the policy was actually originally purchased on the daughter. The daughter was 23 when it started. So when her father finally passes, she's about 55 or so. If I'm
56,
56. Okay, if I'm getting it right. The policy was on the daughter. Now the dad used it for passive income time because he was paying for it. But now the policy's gone. So can you pick back up reading where you were previously?
Indeed. 15 years later, the father is 85 years old and has drawn out cash values of dividend additions equal to the premiums paid into the policy. So it took him 15 years to be able to take out what he put back in at $28,500 per year.
That's right.
Okay. He has no cost basis at all. If he's still living at this point and wants to continue receiving tax-free income, he could simply switch to policy loans, which are income tax-free.
That's right. We all talk about that a lot. Policy loans, income tax-free. Now, do me a favor. Go over to the net cash value section. This is where you get loans from. Cup 2, cash value.
Yes.
Tell me about how much cash value he had available to him if he was still living at the time. It should be lit up in bold.
It is, yes. Okay. So at this point, he's taken out his $400,000 that he put in. He used that, income tax free. Now he has $1.1 million. It's actually $1,110,000 of cash values available.
Now, the book says, if you keep reading, that sounds a whole lot like life insurance. Because remember, the policy's still active.
Yeah.
So when he passes, if he's got $1.1 million worth of cash value that now the daughter inherits, that sounds like life insurance to me, right?
Yeah.
All right, keep reading.
Okay, cool. So The father paid premiums for 20 years, then withdrew every dollar paid out on a tax-free basis and delivered $1.1 million to his daughter at her age 57. In this illustration, the assumption is that Jill simply let the insurance company manage the policy for the remainder of her life. Therefore, no additional premiums. At her age 70, she decides to surrender cash values of dividend additions in the amount of $150,000 for the balance of her life.
Each year for the rest of her life, for the balance of her life. So let's stop here for a second.
Okay.
Here's what's cool about it, right? The dad was able to use this policy, funded at $20,000 per year, 20 years, $400,000, stop paying.
Yep.
Took out $28,500 every single year for the remainder of his life. He passes away. Yep. The daughter still has the policy active because the policy was on the daughter's life. There's about $110,000, $1.1 million. $1.1 million worth of cash value in this policy.
Yep.
Now the daughter doesn't put any more money into it. That's what the book says.
Yep.
She let the insurance company manage it. That's what she means. She doesn't put anything else in it. And now when she's ready to retire, she's got $150,000 every single year that she can pull out of this policy for the balance of her life. The cool part about this is that they exercise two different options here. They exercise taking out your cost basis. The father did.
Withdrawals.
Yep. And the daughter exercised taking out withdrawals based on the dividend additions that are coming out of their policy. So she's got $150,000 for the balance of her life. Let's say that passive income time starts at her age 70, which is just like her dad's was. It's no different. And she takes that money out all the way till she
90, 20 years,
20 years, all the way till she passes. So that is $3,150,000 if my math is right. Does that sound right?
Yep.
Very cool. Let's finish the paragraph out here.
Okay, so assume she dies at age 90. She's withdrawn passive income totaling 3.15, and she still delivers 2.3 million in death benefit to the next generation.
That's right.
All during the period of premium payments and withdrawals, Jill could have been using cash values to finance automobiles, homes, or anything your imagination allows. If she follows the principles taught earlier in this book, then the results would be much greater than depicted in the illustration here.
That's right. So tell me how much cash value was available in that policy that was not used at the time of Jill's passing. So this is year, when she's 90 years old, policy year 68 or something like that. How much cash value do we have?
You are correct, yes. The cash value at that point was $2.1 million.
$2.1 million unused. Unused. Again, her father retired off the policy. She retired off the policy. They hadn't paid a premium in what? 50 years, 60 years?
They hadn't paid a premium in 90 minus 43.
Hadn't paid a premium in over 50 years, pushing 50 years, and they still had $2.1 million in the policy. The reason that I bring this up to you guys at home, you watching or listening, is that a lot of people think that these policies are linear. Is that the way I want to put it? They think that they accomplish just one task, one goal. They think, this is a alternative to my investment. This is
correct.
They compare it to invest.
This is either or.
Yeah, this policy does so many. It's an and option and asset for you, privately owned asset. This policy does so many more things than you understand and give it credit for. Now, again, you can learn a lot of that in this book, Become Your Own Banker. I don't even think we've got any books to sell you. If you're interested in it, go on Amazon and grab it. I think we might have a link for you or something. You can get there quicker, but the book explains it all to you. And I just wanted to show what was possible using this policy. Now, on the very next page of the book, if you go back to it, page, it must be 84 or 85, there are some points to consider.
Yep.
And point number 2 is where I'd like you to read, and we'll finish up talking about that.
If you knew at passive income time that you would be getting back everything you paid into a system tax-free, would you object to putting more money in it?
I certainly wouldn't.
This is so powerful. Every time you level up, you read the book again, and you're just re-amazed at what this thing will do.
You got to. The policy has again, I didn't come from a life insurance background where I knew all this stuff about life insurance.
Of course.
So as
Nobody does. That's the thing. Nobody does. Everybody else thinks they're too smart for this who knows life insurance, but most people are coming from where you and I are.
Right. So as you learn more about the policy, you understand how infinite an infinite banking policy really is, right? The cool thing about this example that I like a lot is that we can design things for you where you take those withdrawals, you also get the loans, and you do both at the same time. So if you're watching or listening to this going, well, $150,000 a year is not enough money for me, I need more than that. You've
come into the trap again of either or.
Yeah, that's right. But I was going to say the expression is don't trip over the dollar trying to pick up the dime. Is that the expression?
Something like that.
Something like that. You guys can correct me at home. Feel free to comment.
Dan Quayle would have said it better.
Yeah, but don't miss it, right? It's so
got to see them forests through the trees. Something like that. Right?
Exactly. It's so powerful. And so that was today's episode. It's about becoming your own banker. It's about how the policies not only can provide income, cash flow to finance your purchases now, but also at passive income time, how they can take care of your entire family, yourself. Again, there's so much more going on. So if you are watching, listening, and you want in a little example, or you want to walk through, you want to ask your specific questions about your policy or about a policy that you're interested in getting, please reach out. We want to chat with you. We want to talk to you. We can answer those questions. We can walk you through this example, whatever makes the most sense to you. We'd love for you to reach out.